Matthew had done everything right. He left his corporate job, built his own consulting firm, incorporated it, to protect himself and save on taxes. By his third year in business, he was clearing $280,000 in revenue. But in March, Matthew got a letter. The government said he owed $47,000 more than he had budgeted for. $47,000. Not because he was dishonest. Not because he had not tried. But because he made one mistake. A mistake so common, so invisible, that most incorporated business owners who not even realize they are making it until it is too late. Today, I am going to show you exactly what that mistake is, why it happens, and most importantly, how you can make sure it never happens to you. If you own a corporation, or you are thinking about incorporating, do not skip this video. The number one tax mistake incorporated business owners make is this. They treat their corporation like a personal piggy bank, pulling money out whenever they need it, however they feel like it, without any strategy. Now that might sound obvious, but here is the thing. It is not that people are being careless. It is that nobody told them the rules have completely changed the moment they are incorporated. When you were a sole proprietor or an employee, money coming in was your money. Simple. You paid tax on it, you spent it. But a corporation is a separate legal entity. It has its own tax rules, its own relationship with the government. And how you take money out of that corporation can mean the difference between saving tens of thousands of dollars in taxes or handing it straight to the government. Let me show you exactly what I mean. Let us go back to Matthew. 3 years ago, Matthew incorporated on the advice of his accountant. Great idea. Corporations in Canada enjoy significantly lower tax rates on business income compared to personal rates. In Canada, for example, the small business tax rate can be as low as 12.2% in Ontario. Compare that to personal income tax rates that can climb to 45%, 50%, even 53%, depending on your province, and you can see why incorporating makes sense. Matthew knew this. His accountant told him, "Leave money in the corporation. Let it grow. That is how you build wealth." And Matthew nodded. He got it. But then real life happened. A new truck. A kitchen renovation. His kids' private school fees. Vacation to Portugal. None of these were extravagant. Marcus was making good money. He just started paying for things from his corporate account, or taking large lump sums whenever he needed cash. No strategy, no structure, just, I need money, let me grab it. Sound familiar? This is exactly where the mistake lives. Not in laziness, not in dishonesty, in a lack of structure for how money flows from the corporation to you personally. When you own a corporation, there are two main ways to pay yourself. And the mix you choose has a massive impact on your tax bill. Number 1. Salary. A salary is when your corporation pays you as an employee. Corporation deducts that salary as a business expense, lowering its taxable income. You then pay personal income tax on that salary. Salary also creates what is called earned income, which means you can contribute to your RRSP in Canada. It also means CPP contributions in Canada, which is both a cost and a future benefit. Number 2. Dividends. Dividends are paid after the corporation has already paid corporate tax. You then pay personal tax on the dividend, but at a lower rate than regular income because of something called the dividend tax credit in Canada. So which one is better? The honest answer. It depends on your situation. And that is the point. The right mix of salary and dividends is a strategy, not an accident. But here's what Matthew was doing, and what most incorporated owners do wrong. He was not paying himself a salary at all. He was not issuing formal dividends either. He was just moving money, transferring lump sums, paying personal bills from the corporate account. No T4s filed, no dividend resolutions. To the CRA, those random withdrawals get classified as shareholder loans. And if those loans are not repaid or properly documented within a certain time frame, they get added back to your personal income, taxed at the full personal rate, with interest, and sometimes penalties. That is what happened to Matthew. Over 2 years, Matthew had pulled $190,000 from his corporation in various transfers. Some months it was $8,000. Some months, $25,000. He paid his mortgage, his car payment, his family vacations, all from the corporate account. His bookkeeper tracked it all as due to the shareholder, a running tab. What Matthew did not realize was that under CRA rules, a shareholder loan must be repaid by the end of the fiscal year following the year it was taken. If it is not, and if it was not structured as salary or dividends, it gets included in your personal income. So when his accountant did the year-end, $47,000 of those withdrawals could not be properly categorized. They had not been declared as dividends. They had not been declared as salary. The repayment window had passed. Matthew was hit with a personal income inclusion of $47,000 on top of everything else he would already paid tax on. This is not a rare story. I have seen this happen with dentists, real estate investors, contractors, consultants, coaches, smart, hardworking people who simply did not know the rules. So what should Matthew have done? The fix is not complicated, but it requires intention. Step 1. Decide on a reasonable salary. Work with your accountant to determine a salary that makes sense for your role in the business. This salary gets deducted from corporate income, reducing the corporation's tax. You pay personal income tax on it, but you are building RRSP room and it is clean and documented. Step 2. Plan your dividends strategically. At year-end or quarterly, your accountant can declare a dividend from corporate retained earnings. This is done formally, with a dividend resolution signed by the directors. The amount is optimized to fill up lower personal tax brackets without pushing you into a high rate. Step 3. Stop paying personal expenses from the corporate account. If you need to buy something personal, pay yourself first, salary or dividend, then buy it personally. If the corporation accidentally pays for something personal, document it immediately and either repay it or include it as income. Do not let it sit unresolved. Step 4. Set up a shareholder loan account properly. Sometimes it is appropriate to loan yourself money from the corporation, but it must be documented and it must be repaid on time. Your accountant should be tracking this monthly, not scrambling at year-end. These 4 steps: salary, dividends, no personal expenses, clean shareholder loans, are the foundation of a tax-efficient corporate structure. After that $47,000 tax shock, Matthew made changes. He sat down with a new accountant, one who specialized in owner-managed businesses. Together, they built a compensation plan. Matthew started paying himself a $90,000 salary. At year-end, he and his accountant declared a $60,000 dividend, structured to minimize his overall tax rate. He opened a separate personal checking account. Corporate money stayed corporate. Personal money stayed personal. The result? In the following year, same revenue, same lifestyle. Matthew's total tax bill dropped by over $30,000 compared to his chaotic approach. He also had $40,000 sitting in his RSP, building for retirement. And for the first time, he did not dread tax season. That is the power of strategy over accident. Same business, same income, completely different outcome. If you took anything from Matthew's story today, let it be this. Incorporating your business is one of the smartest financial moves you can make. But a corporation is only as powerful as the strategy behind it. Here is your action plan: 3 things to do this week. 1. Pull up your corporate bank statements from the last 12 months. Look at every transfer to your personal account. Are they documented as salary or dividends, or are they just transfers? If they are just transfers, talk to your accountant immediately. Coats, your accountant. What is my shareholder loan balance? If they cannot answer that in under 60 seconds, that has a problem. 3. Schedule a compensation planning meeting. Before your next fiscal year end, sit down with your accountant and decide how much salary, how much in dividends, what is the optimal mix for your tax bracket. This one conversation could save you tens of thousands of dollars. If this video helped you, please share it with a fellow business owner, because I promise you, someone in your network is making this exact mistake right now, and they do not even know it. Hit subscribe if you want more videos on building real wealth through your corporation. And drop a comment below. Tell me, are you paying yourself salary, dividends, or a mix? I read every comment. I will see you in the next one. If you live in Ontario and want to save like a wealthy retiree, scan the QR code or click on the link in the description to see if we are a fit.